If you've been looking for ways that you can take advantage of the stock market when it's down, this video will give you some direction. The last thing you want to do is put all your eggs in one basket. That's why I recommend diversifying your portfolio with a few different products that are based on different industries and sectors. You'll be able to see what works for you and what doesn't, and then make changes accordingly. In this video, I'll be walking you through the ways that you can invest in the stock market when it's down and make the most of your investment portfolio. Step 1. Talk to your advisor. Your advisor can help you create a plan, which will help you diversify your portfolio and set up a plan of action for investing in the stock market. It's hard to know what to do with your money. That's why you need a financial advisor, someone who can give you valuable insight into what you should be doing with your money to reach your financial goals. But they don't offer their advice for free. The typical advisor charges clients 1% of the assets that they manage. However, rates typically decrease the more money you invest with them. Step 2. Accept that there will be negative years. The stock market is volatile, and that's normal. It's easy to think of the stock market as a high-stakes casino game where fortunes are won and lost in an instant. This may be true, but it's also misleading. The fact is that there have been plenty of times when the stock market had negative years, and even decades over its history, and many more periods where it was positive for long stretches at a time. The important thing to remember about investing isn't just that you can make money if you pick the right stocks at the right time. It's that even when things go wrong, you're still taking part in one of humanity's greatest endeavors. Investing your hard-earned money so as to improve your family's prospects for generations to come. So, don't fret when the stock market makes a negative move. Just keep going. Step 3. Rebalance. If you have a target allocation that's not being met, it's time to rebalance. First, look at the allocation of your portfolio in percentages and see if it needs adjustment. If the allocations are close to what they were initially, it might be best not to change anything. If anything, consider adjusting how much of each investment type is represented in your portfolio as a whole versus each individual investment account. If your original allocation, say 70% stocks and 30% bonds, has shifted significantly over time due to market conditions or other factors, say 60% stocks and 40% bonds, then now would be an ideal time to rebalance back toward the original target allocation by selling off some of those more volatile investments and reinvesting in less risky ones. Step 4. Take advantage of dollar cost averaging. Dollar cost averaging is a way to buy a fixed dollar amount of a particular investment on a regular schedule, no matter what the share price. It's an excellent way to invest, particularly when the market is volatile or you don't know when or if it will rebound. When you sign up for dollar cost averaging, your brokerage automatically invests money from your account into the same investment on a regular schedule, for example, once per month or twice per quarter. You set how much money should be invested. This is called the investment amount or dollar size. If you want to keep buying more shares at lower prices as they become available throughout time, then increase this number accordingly as well. Step 5. Diversify your portfolio. When the stock market is down, you may be tempted to panic and sell all of your investments. But this is not a good idea. It's better to diversify your portfolio. Why? Because diversification reduces risk by spreading it across several different types of assets. Instead of investing all your money in just one kind of investment like stocks, you can also invest some of it in other types of assets like bonds or real estate. The greater the diversity among these investments, the less risky they are as a whole. The best way to diversify is by investing in multiple asset classes, for example, both stocks and bonds, and then again within each asset class by purchasing different mutual funds or exchange-traded funds. Step 5. Only invest what you can afford to lose. Investing is one of the best ways to build wealth, but it's also a high-risk venture. Not only can you lose money, but you can also lose sleep. If you're new to investing and don't have a lot of experience with it, start small and invest only what you can afford to lose. If something goes wrong and you lose your job or some other unexpected thing happens, like your car breaking down, it's good to know that there is a safety net underneath you. The last thing anyone wants is to be homeless because they were investing everything they had into something that didn't work out as expected. Step 6. Look for opportunities. As a value investor, you would be looking for companies with low stock prices relative to their earnings or book value. If you're investing in a growth company, the value of your investment will probably increase over time as it grows into its valuation. You will want to avoid companies that are facing problems or have too much debt. A company's financials should also be transparent so that you can see how they've performed in the past and predict how they'll perform in the future. There are ways to take advantage of the current market situation. If you're interested in investing in the stock market, there are a few ways to do so. You can buy stocks directly from a company. Companies will often offer their shares for sale directly to the public, which means that you can purchase them as well if you wish. This is also known as direct investment. You can also buy shares of mutual funds through brokers and other financial professionals who act on behalf of investors like yourself. This is called indirect investing because one party, the investor, gets involved only after another party, the broker, has made the investment decision on their behalf and purchased those shares on their behalf through some sort of intermediary vehicle like an exchange-traded fund. Step 7. Maximize your retirement investment. The best way to invest in the stock market when it's down is to make sure that you are maximizing your retirement investment. It's never too late to start making a contribution, but starting now will give you many years for compound growth of your money and help ensure that you reach your financial goals. Make sure that you're taking full advantage of employer matching contributions and other tax advantages by contributing enough money each year so that all available matching funds are used up before the end of the tax year. If possible, try not to withdraw any funds from this account until after age 59 and a half. This is when most early withdrawal penalties go away. Finally, there will always be a time when the market is down, which is exactly why you should take advantage of it by giving yourself opportunities to invest and having an advisor you trust. It's especially important for those who are about or already in retirement because it allows them to expand their portfolio and get more returns from their investments. While taking advantage of this situation may seem risky at first glance, there are several things that can be done in order to ensure success, like diversifying your portfolio or reallocating the funds from other investment vehicles into equities. And if you think carefully about how much money you want to invest into stocks, then we guarantee we'll find success. It's been great talking to you today. Thank you so much for watching this video. If you liked it, please like and subscribe. And if you have any strategies that worked for you in the stock market, leave a comment below. Also, be sure to check out my podcast in the description below. Thanks again for watching.